I am extremely passionate about. It appears that when we look at ICO, often entrepreneurs would come to me and say, hey, this is a non-dilutive financing event. There's no hit on equity, there's no debt, it's like a free money.
I vomit in my mouth.
Yeah. So why is that? So now, kind of wearing my corporate finance type of hat, and then look at this entire ICO financing mechanism through the lens of, let's say, Goldman Sachs Bank. I'm classically trained corporate finance, asset equal to, the equity and debt. And then there's an ICO, and I just raised $50 million. How do I even put that into my balance sheet? What is it? Is it sales or so? My intuition tells me that our conventional way of valuing an asset needs to be rethought out. It needs to be reinvented. And somehow ICO is giving us an opportunity to start valuing things like loyalty, community involvement, or interactions. And we get to put dollar signs on those. So am I just thinking too conceptually here, or is there any agreement with myself?
No, it's reinventing. If we go from the world of A to Z, call it B being building businesses, we're moving to the next letter in the alphabet, which is C, which is you're building community. And you have to think very differently. I mean, business is about, producing a return for investors. And that is the fiduciary obligation of anyone that runs a business. Is you're seeing some of the biggest companies in the world get interested in social impact and trying to figure out how to give back in some way. They're being prevented by their shareholders. They're not legally allowed to help the world. They are obligated to serve the shareholders. And the second any company wants to do otherwise, they are not allowed. I mean, yes, we need to fundamentally rethink everything we're doing.
It's thinking instead of the power of the shareholders, the power of the stakeholders.
Yes.
So it's shareholders to stakeholders. If you have a token that all the stakeholders, let's say a decentralized Uber, where the taxi drivers, the riders, the people building the application, the people sustaining the network, they all have tokens. They're all stakeholders, right?
Exactly.
So they're working for the stakeholders, not for the shareholders.
Yeah.
And that is kind of democratizing, who makes money. Because if Uber is successful, only Uber shareholders make money. The taxi drivers don't make money. The people using the taxis don't make money.
Yeah.
But on a decentralized Uber, every stakeholder can potentially benefit from the success of the community. And that's a radical way of seeing things.
Realigning interests.
I think if you look at the different stakeholders involved, right, the entrepreneur, he gets to create a whole new asset class that didn't exist before, and is incentivized to perform well because he holds a certain amount of this asset class himself. The token goes up in value, he benefits, he gets liquidity. The community also ends up becoming the first users. That came from the app space. The app space will allow you to get the first users, or also small investors in your company. So you have a certain responsibility towards the retail investors. I mean, institutional guys, they can lose money without a second thought. But the retail investor, that's probably his paycheck that he's put into your project. So looking at the investor, he gets liquidity right away. The entrepreneur, he gets a whole new asset class that did not exist before. And the users, well, they're part of it. They get a chance to feel being a part of the project, and they actually have a lot of control over it instead of just being on the sidelines. So, I mean, I think it's a really, really great model. Obviously, there's flaws, but everything has flaws when it starts, and over time, things mature. And that's what we've been seeing with security tokens.
I think from a corporate finance perspective, nothing has changed. The equity is still ownership, debt is still a liability, services are still something you provide and get money for, and then tangible value like brand and loyalty are still part of the equity, right? What becomes a problem is when you are selling a service and calling it equity, as Brock mentioned. This is where you are borderline breaking the law. You are redefining something that is not true. So if you're issuing a utility token, it's a promise of providing a service to somebody. It's almost like securitizing future sales. And if you call that equity, it's borderline troublesome. That's where going to a security token is absolutely the most logical way to deal with it. Now, what the smart contracts do and what the blockchains provide is a more transparent, more equitable way of distributing that value, so that it is not captured by one small set of shareholders who have the ultimate power to utilize at their will.
Yeah, so like, if I may add, Cameron, all due respect, I completely disagree with you. Because I think when people talk about shareholder, I think in the past 5 decades on Wall Street, what drove the economic activity really boils down to one thing: shareholder value maximization, right? And I see a lot of fallacy in that. And that is, who really is the owner of a corporation? Is it just the stockholders that are the owners? What about customers who are actually adding a lot of value to the ecosystem? For example, I run a game company. I had 20 million people playing the game. Me as a company, we inject a lot of content. But that's only a portion of the experience. The other good portion, the value that people enjoy, comes from other players who are playing the game. They're not shareholders. They're customers, but they're also part of the production of that value. So how do you actually put proper economic value to that contribution? Today's, I say, accounting system cannot. I think it's archaic.
Cameron, I agree with everything you said, but I also agree with everything you're saying.
Me too, and this is what I want to point out. What we are now entering is with this sort of third ledger and a third level of accounting, which is a three-way accounting, is now finally a point where those users get a piece of the equity, which the current structure doesn't allow. That's why tokens are important. I'm just pointing out the difference.
More equitable. You made the comment. It's more equitable.
Exactly. So
Progress.
I'm just differentiating between a utility token and a security token, but I'm not undermining what you are saying, which is with the token, you will now have the economics which allows some of that value to go to the users.
There's 2 points though that just to make on the whole macro of why this really matters. The ICO is putting venture capital out of business.
Absolutely.
There will be the venture industry. I mean, if you're an LP in venture funds right now, I would be selling what you got as fast as you can. I mean, dump it now, pennies on the dollar. Why? The venture business is a portfolio business. You're diversifying risk. I mean, I've been in venture capital now, but a lot of funds. I mean, the venture business is all about having a diversified portfolio because you're going to lose all your money on a bunch of deals. You're going to get a single, you're going to get a double, and the success of your fund relies entirely on catching a unicorn. How many unicorns that are going out to raise their Series B financings today are going to be taking it from Sequoia or Andreessen Horowitz? I'd say near zero. All the unicorns are already gone. Now, it'll take 5 years to see that reflected in the returns of these funds, but any of the generalist venture funds that have a couple $100 million or more are done. I mean, they're going to look like 2001 vintage venture funds. You're going to see complete loss of capital in many instances. You're not going to get your bacon back even. And the unicorns are gone. The unicorns are all here. This model is literally replacing the entire economic structure of venture. It's game over. Now, the $20 million funds, the $50 million funds, the real venture capitalists will still be fine because they're doing the seeds and they're doing the A's. Venture capital has already been dead. It was taken over by financial engineers. There's no VCs. I mean, there's very few VCs anymore. They're a bunch of fakers. It's bullshit. These are financial engineers. It's been co-opted, and you got big funds that have been capturing this liquidity market and the B's and the C's and the D's. And essentially what's happening now is companies that are in a Series A or a Series B state now can go public. Either as a security token, utility token, whatever the structure is. But that's the essence of what's happening, is there's no more growth equity left. It's done. This will happen to private equity too. It's going to happen to real estate, longer conversation. But it's game over for a number of industries right now in finance. And so, just to put it into simplicity, where this goes, because ultimately, goodbye NASDAQ, goodbye New York Stock Exchange. Not to say that NASDAQ won't survive the transition of the innovator's dilemma, but I mean, on the most basic level, I can go public on the New York Stock Exchange, London, wherever, right? That's a market that's local by nature, that operates from 9 to 4 on weekdays, running on really old, really slow, really expensive, insecure technology, versus being able to list globally on a market that runs 24 by 7 by 365 on the most secure, efficient technology the world's ever seen. How do you think that story ends?
I want to pick up on something you said and then Brock said, which is Wall Street the last, let's say, 20 years, 30 years, it was all about maximizing shareholder value, right? And this creates misalignment within the organization, right? Because you have the shareholders, which basically want to make more money and get dividends and stuff like that. Then you have the management that wants to actually spend money to grow the company, which is misaligned with what the shareholder wants. Then you want the employees that want to basically be paid more money, and you want the customers that want the cheaper service. So there's a complete misalignment across the stakeholders. And I think the decentralized world, what it brings, with the token distribution across all the stakeholders, is an alignment of interest to make something successful. And then the mantra needs to be not maximizing shareholder value, but maximizing stakeholder value, which is not just one type of entity, but multiple, employees, customers, developers, the network, etc.
Well, this is the point I'll make probably tomorrow at some point, but there's 3 constituents. You've got the customer, the employee, and the shareholder, if we want to boil it down into the simplicity of the Trinity. You've got those 3. The customer just wants the best product and service at a reasonable price, money for nothing and chicks for free if possible. They'll take it, for free if possible. But the customer just wants that, right? The employee wants to show up, do something they feel good about, hopefully enjoy their life, and be appropriately remunerated for their efforts in a way that they're happy, ideally. The shareholder just wants a maximum return on investment. But there's a complete misalignment of interest between these 3 parties. But what happens in these tokenized models is something magical. I mean, something truly magical. And that is, if I want to be a customer of one of these systems, imagine if you could only buy Apple products with Apple stock. That means if you're a fan of Apple, you want to participate in the Apple community and you want the Apple products, you will have to get the token, or the shares in this particular case. But now that I'm only buying Apple products with Apple stock, I start benefiting from anything that community does. If the Apple community is thriving and doing well, I'm benefiting. I look like a shareholder now too. So I started out with a customer intent, but somehow I'm now a shareholder, even though that wasn't my original intent. It just kind of came with the territory. But now that I'm also benefiting from anything that happens in that community, I'm wanting to contribute to. Meaning I might, tell my friends about it. I might, if I'm a designer or a developer, start designing cool things for that community, start building applications on top of it for that community. And so what's happening is you're seeing an alignment of interest occurring. And that is that I go from wearing one hat in a historical world to wearing all 3 hats. Meaning that the lines become very blurred between customer, shareholder, and employee. It looks more like tribalism. You become a member of that tribe or that community. And the other thing that happens, because it's all open source, is that when I see a good idea, historically, I hide it in my pocket. I keep it to myself. That's my proprietary thing. I'm going to figure out how to monetize that and capitalize on it. But something also magical happens when you open source that entire thing. And that is, if I have a good idea, or I have an insight that's valuable, it's in my best interest to share it versus hoard it. It's in my best interest to share that idea or implement it immediately. It's not in my best interest to try and hoard it for myself, to make it proprietary. Meaning, it doesn't matter if anyone here or any of you implement that idea. Anything you do benefits me, anything I do benefits you. And so it's no longer in my best interest to hoard insights. it's in my best interest to share it as fast as possible, because if anyone implements it for the benefit of our community, we all win together. It's a win-win-win-win-win. And as you start to go from a world of me and you start thinking about the world of we, how do we collectively win together, and you start thinking about that we in community, again, magic begins to happen. And these are the fundamental changes that are happening structurally, to society as a result of these innovations. I mean, this is the most important thing happening in the world right now with AI.
Hey, James Glasgow, I'm sorry, like, you're supposed to be on the stage.
Well, then why don't you just come up?
Okay, you go.
There's a seat right here.
I don't know what happened.
All good.
My brothers.
Yes. So James is a former chief marketing officer of Playboy, and and also co-founder of DNA Fund out of Santa Monica. So please spend a little bit of time introducing yourself. Any thoughts or ideas that you want to share, please?
Sure. Hello, everyone. Nice to meet you. James Glasscock. Brock and I have known each other for about 13 years. He called me about 8 months ago. It was August 23rd, and just sent a text message said, "Come over." And I was busy that day. I couldn't make it that day, but went over the next day, and that was the 24th, and spent about 6 hours on a rooftop talking with him and his partner, Scott Walker, about how to kind of systematize and operationalize and scale servicing the community. What Brock and his partners had already created was really open sourcing the conversation around how to do token sales, how to invite people into the community, really to give them kind of a head start into their project. So we built something called DNA. Website is dna.fund. If you want to follow it on Telegram, it's DNA Community. But we, gradually started putting things together, and we've had an incredible run together. About 20 portfolio companies, and back to sort of the original topic here, Joshua. What I thought was kind of interesting. A friend of mine had shared a slide a few weeks ago. When you look at Facebook or Netflix or Twitter, what you'll find is kind of an obvious here, but they have more users, more subscribers than they do actual shareholders. And so, one of the things that we're sort of pinpointing around in this conversation is that you have this community of users that are completely different than the folks who own shares and influence in those companies. And to me, that's one of the really exciting opportunities that tokenization enables, and we're going to see more of that in the future in companies that, Brock said, Innovators dilemma. All of those companies have it. It's going to be very difficult for them to evolve. They won't revolutionize their business. Hopefully they will evolve their business. I think one of the things that's really exciting about in this world of tokenization and new entrepreneurs is the revolutionaries are probably not going to be the big established companies. It's going to be a new entrepreneur who has little to lose and everything to gain.
You missed my favorite part of that story. Your transition from that day, and how long did it take you?
Yeah, so just to give you some more context, on the 23rd, I was an employee at Warner Brothers. It's a film studio in Hollywood you've probably heard of. We had sold a gaming company to them about a year ago, a year prior. So my 6 hours on the rooftop of August 24th with Scott and Brock was quit your job tomorrow. And probably in hour one when we had that conversation, I was like, that's kind of hard to do. You just got to walk away from money and all kinds of things like that. By hour 5 hours, 59 minutes into the conversation, I think I was ready for it, and I walked in the next day and had that conversation with them. It was difficult to do, but one of the things that was so valuable about that for me is I realized in that very moment I was making exactly the right decision, because they didn't get it. And prior to that conversation at the company. I had looked around, I'd asked around, I was asking, who's thinking about blockchain? You know, Warner Brothers owned by Time Warner, soon to be owned by AT&T. And the conversation wasn't being had, and you could just see how, you know, as companies get big and mature, they like to, you know, not necessarily think about how, you know, what is the next step for us. It's kind of like waiting who's going to buy us next.
Yeah.
But I'm glad I made that decision to join you, Brock, and glad to be here with all of you for that reason.
Yeah. You know, so I was acting as a VC for my fund for about 2.5 years, and I realized that in the end, when there's a great investment opportunity appears, the real crown jewel of value encapsulated in that particular opportunity is really about entrepreneur. Who is running it? Who is executing the business thesis? And what I'm now seeing is some of the best and the brightest entrepreneurs out there are actually refusing to go talk to VC and say, you know what, I don't need to go to Silicon Valley. I don't need to go talk to Sequoia. I could just do my ICO, get my first 5 million, and then launch my project. And I think that subtle shift in the mindset is incredible. I think that is right now literally unleashing the new sort of the wave of most talented, young, aggressive entrepreneurs to come in and pursue their passion projects. And that's what I see in ICO.
Well, yeah, I mean, if you accept a term sheet from Sequoia today, you're going to be embarrassed. You can't tell anyone. I mean, you'll be criticized and ridiculed at dinner.
But I must add that the part that a lot of those entrepreneurs are still not fully getting is the part that Brock mentioned, which is the community and all of the benefits that brings in. Because that's about not just building a company, that's about building a shared prosperity. And this is why, you know, when we talk about infrastructure in other areas, you know, imagine we all sharing in the financing of a infrastructure that we are all going to use, or we all share in the rebuilding of Puerto Rico, where we either all live or we want to support. So, you know, they could be global projects, they could be very narrowly defined benefits, but I hope that this community continues to stay focused on this, the community shared prosperity idea, which the token actually provides as an instrument, and not get lost in where can I raise money quickly.
I think it's a terrific comment. We see a lot of projects that are pitched, unfortunately, are, you know, entrepreneurs think it's an easy way to raise money. And in many cases, these are centralized companies that plan to remain centralized after raising their capital. I think that's super unfortunate and will probably be short-lived. You know, what we're not seeing yet is the market holding accountability for a lot of the projects out there. One of the things we look at DNA, and I look at in every project get involved in, is what's the plan for governance once the capital is raised? What's the plan for scaling business development, delivering your product, building partnerships, and actually solving a problem for the marketplace? I think that's important, and then the idea of what is the governance structure of this, and how does the community play a role in it? We're not seeing enough projects with that. We're seeing there's a few that are incredible projects. They really are the cream of the crop, but there are many out there that don't have it, and I would encourage you, if you're thinking about, you know, those types of investments or the future of ICOs, you know, really pushing the entrepreneurs, like what is the governance plan once the capital is raised?
Yeah, at least 90% of the projects are absolute garbage.
So I think there's another thing important. So if you remember at the 90s when the internet started, people thought the internet was going to democratize many things, access to information, access to content, access to communications, etc. And if you think about what has happened, it's actually the opposite. Today, the world is more centralized because you have very few companies like Facebook, Twitter, Google, etc. that have a huge size that didn't exist 10, 20 years ago, that concentrate all the power and all the control about what happens on the internet. And the business issues with Facebook actually shows that that's a problem, right? And if you think about why this has happened, is because the original internet protocols, HTTP, VoIP, TCP, AP, etc., didn't have any value. They were not monetized. They were open source, which is the right thing to do, but they were not something people could actually, benefit from. And then the value moved up into the application layer and it got highly concentrated. So I think that people building decentralized protocol with a monetization mechanism through the token for all the stakeholders is going to avoid, hopefully, that things will get again centralized at the application layer, because the value will be at the protocol layer. The protocol layer, by definition, is decentralized and monetized by all the stakeholders.
I think we also need to focus here on the fact that ICOs are not the easy way to raise money. I think when you're doing an ICO, you're taking a lot of responsibility. I'll even go as far as saying that doing an ICO is like running a whole business separately from doing your main business. Because the amount of work required post-ICO is tremendous. I mean, it costs 10 times more money to list on the premier crypto exchanges compared to listing on NASDAQ or some exchanges. I mean, it's a lot of work post-ICO, and then you also ask for the community. Yes, the community is the upside, and I'm totally for that. But then you also got to remember that when this community becomes your investors, those guys are spending 24/7 on your community channels asking questions. So most founders do need to understand that doing an ICO means taking a lot of responsibility on yourself. You need to be prepared for that. You need to be equipped for that. It's not the easy way to raise money. The easy way is still going to venture capital, because they're looking for options right now.
Completely agree. It's a year of your life,
Exactly.
and you're going to be consumed. If you're lucky, it's just 6 months, but it's probably a year. And then, by the way, once the money's raised, now you've got to go build the business, build the product, and deliver.
And while you're building that product, you still got to be way more responsible to your investors, because now the investors are retail guys who are much more risk involved.
We have very limited time, and I want to end with this burning question that I have, that is, what I'm seeing now in the marketplace is really, really awesome, profitable companies come to, let's say, me or most of you, and say, I'm doing 100 million a year, maybe 20 million EBITDA. Strong company, strong customer base. Now I want to do my own ICO. It's going to be outside of my cap table, and I want to raise 50 million, 100 million, 150 million. And so in that situation, my biggest issue is, okay, so how do you create the right governance structure for that kind of capital raise? Because it's not exactly part of your balance sheet. It's not dilutive.
They're typically scams.
Why would an established company with a centralized traditional model we want to do an ICO? I'm assuming
scams. They're scammers.
Doesn't make any sense. If they want to do that, they should just do a security token instead of a private placement to benefit from a completely different advantage, which is basically the automation, the inclusivity, the liquidity, etc. But not, and this is the balance sheet, because security token you need to assign some
money for nothing. Come on, that's why.
Okay, but there's some exceptions, and I want to clarify. So we absolutely are seeing, at least in our space, in infrastructure space, where there's an infrastructure service provider that is doing business in a very conventional way. But anytime you want to expand your footprint and you want to provide, let's say you are an electricity provider, and there's another community that does not now have proper access, either not the right voltage or whatever. If you want to expand into that region, you typically have to go to the government and get a guarantee. That's how you typically raise money. And it's been a real constraint to growth of infrastructure and real issue, especially in fast emerging economies. So a number of these companies are now saying, instead of going through that drama, which is laced with bureaucracy and therefore corruption and delays, we're going to now go and issue a token and raise the money that we need, the capital, to expand our operations. So that's an example of a very established company that is looking at this new tool, this new instrument, to actually solve a real society problem. And our fund is actually very much focused. We're building a whole business around supporting people like that. So we would go and underwrite maybe 3 to 5% of that token as the domain experts who actually not only will look at their governance of how they will handle their community, but also how they will interface with the government, like actual regulators. So I think those opportunities will arise, which will not be scams. Right now, I have to agree that vast majority of those ventures are a bit shaky.
Well, I mean, the thing about the governance evolution that we've seen across the tech industry, you used to start a company, you raise your money, you get your dilution, you eventually go IPO, and what we saw with these, tech companies were the founders were able to maintain control for some extended period of time due to rapid success. Businesses going from 0 to $1 billion in a short period of time. Founders were doing IPOs and giving themselves all the voting stock. So you saw this with the Googles, the Facebooks, the Zyngas, the Ubers. You've seen founders maintain absolute control through that process, and founders love that, and that's kind of been all the rage. Now they're going, look, I can control everything and not even give up any stock. I mean, and it's not that they're all scams, obviously. It's just, to the founders that were really good at basically subverting all governance and or maintaining all governance for themselves, they're like, oh, now I don't have to give anything up either. I mean, of course it's fascinating, and just don't be a victim of it. The last insight I'll give you on a market is you talk about things like Facebook and Uber. Those are the businesses I wouldn't want to be a shareholder in. These are businesses that are intermediaries that don't add much value. And their entire business is valued based upon having a network effect. They've succeeded in basically capturing a market and then controlling the market by making themselves an intermediary by creating a bottleneck because they've got a liquidity of buyers or sellers or users, however you want to look at it. Those are the businesses that this industry will disrupt first. I wouldn't want to be a shareholder in Facebook or Uber. I do like, on the other hand, the Amazons of the world and the Apples and the ones that actually have real infrastructure. Stuff that you can't just replicate. No one's going to be creating a new iPhone in 3 months. No one's going to be replicating Amazon's fulfillment infrastructure in a few months. The Facebooks and the Ubers don't have much.
I just think I said because that, every time I see an ICO that just wants to issue a utility token purely to raise money because it makes no sense to use it in the company, just because things is easy money, I just don't touch it with a pole. Because that to me is not a legitimate usage. If they do a security token, that's a different story because that's just like a better way of doing traditional fundraising, and this then is on the balance sheet and it's either equity or revenue share. That's a different story. But a lot of these people that they just see $5 billion for raising ICOs and they think, oh, I can't raise money in the traditional way, just raise by doing an ICO and issue a utility token. That makes no sense. I think this should stop, and I encourage no one to actually invest in those businesses so they end up disappearing.
On your question, Josh, companies with $100 million, maybe $1 billion a year in revenue, there is an opportunity around tokenization, which I am very attracted to. It's where they are using blockchain to basically reduce costs, reduce friction in their core business. But there's an important addition to this. It's about ultimately open sourcing that ecosystem for them and all of their competitors in the ecosystem. And you're starting to see it. There's a few companies that are doing it. I think you'll see Wax Token go down this path. They built solutions for themselves first. And it becomes a marketplace to invite the entire community, their competitors, to participate in that ecosystem. And the value of that ecosystem could be orders of magnitude more valuable than the centralized company ever will be. So, for the companies that are out there thinking about tokenization and raising capital, I hope it's less about the raising capital part and more about, number one, making their core business run better. Number two, open sourcing it for the entire community so we can build a different ecosystem, different way of thinking for commerce and community.
I think also one more point to add on would be that if a $100 million company has 100 million users is coming onto the blockchain, that's a plus for all of us because it's bringing on new people that were not exposed to crypto or blockchain before. When a major company comes in and does an ICO, I'll look at the upside because not everybody's a scammer. There's also nice people out there. And once a big company started doing ICO, they're probably bringing on all the user base. and probably some part of the revenue on the crypto markets too, which eventually exposes more people to the beauty that blockchain provides. So I think there's also an upside to companies like what he mentioned that are looking at doing ICOs, because it's bringing in a new influx of users that did not exist before.
But it's not about the ICO, it's what James said. It's about decentralizing the business, right? It's just saying, I changed my business model, and because I changed my business model, then I have a legitimate reason to basically issue a token and potentially do an ICO. That's fine, because that's basically embracing, the new decentralized world of blockchain and putting the power in the community. But a lot of the ICOs I see, they're not like that. They just keep with their existing business model and just issue a token to fundraise.
What does ICO mean? What are those three letters? What's that acronym stand for?
You should know that.
Initial community offering.
There we go, much better. Because people say coin offering, but an initial community offering. But you want to drop the I out of the ICO and just remember it's a community offering.
Well, I would just use myself as an example. So if I, from Goldman Sachs, JP Morgan, World Bank, I have come to this community because I see the technology, the instrument as beneficial to what I want to achieve, the impact I want to have in this industry, and the people who I want to work with and whose lives I want to affect. So I think in the same way, there are a lot of companies out there who are going to think the exact same way at a corporate level and to say, we have been providing this service, we have our clients, we have our customers, but we now have this thing called tokens, and we have this blockchain and smart contracts. We want to use that to have a better relationship with our customer. And yes, to your earlier point, perhaps even pass some of the value that was captured exclusively by our shareholders to some of our customers. So I think we should be open and welcoming to these companies coming to that, and I suspect that this is going to happen a lot more than we expect.
Okay. So I think we gotta end this panel because we're running behind. So thank you, guys.
All right,